Thank you, Mr. Chairman. Chairman Bernanke, as you mentioned in your testimony, the Fed is currently monitoring whether its prolonged near-zero interest rate policy could result in excessive risk-taking and threaten the financial stability of the United States. I'm interested in what specific metrics you use to evaluate whether these risks are increasing.
Well, first, Senator, we have greatly expanded our resources that we use in the monitoring process. We've created a new Office for Financial Stability. We're working very intensively with the Financial Stability Oversight Council, so the amount of effort we put into this has greatly increased. Our internal monitors, in turn, report regularly to the board, and they report to the Federal Open Market Committee. So our discussions of monetary policy include extensive discussions of financial stability issues. The kind of metrics that are used include things like leverage. Are people who are investing taking on too much leverage? Are asset valuations out of line according to standard metrics? Is interest rate risk or other kinds of risk too concentrated? As you know, of course, the Fed is also a bank supervisor, so we spend a lot of effort looking at our banks and our other financial institutions, trying to ensure that they have appropriate capital, appropriate liquidity, and are appropriately managing their risks. And so there's a wide range of ways in which we look at this. Again, as I indicated, we're watching this very carefully. To this point, and I think this is a view shared by others on the committee, while there are things that we really have to pay attention to, at this point, they're not of sufficient concern that they outweigh the important benefits of trying to support a continued recovery.
Well, thank you. I probably would disagree with those conclusions. I know a number of my colleagues are going to get into this issue a little further, so I'm going to go on because of the shortness of time. I want to talk with you briefly about Dodd-Frank reform. If we are able to achieve some bipartisan consensus on steps to improve Dodd-Frank, what are some of the provisions that you think need clarification or improvement for reconsideration?
Well, first, as a general matter, Senator, Dodd-Frank is a very big, complicated piece of legislation. It addresses many different issues, and I'm sure there are many aspects of it that could be improved in one way or another. I recall, in fact, that you yourself had a bill 5 or 6 years ago on reg reform and simplification.
That's right.
Which was a bipartisan effort to find ways to reduce costs without losing the purposes of the regulation, and I think something along those lines would be very doable in this context. The Federal Reserve would certainly be willing to work with you closely. In terms of specifics, we'd want to do the work, of course, but you mentioned in your opening remarks the end user issue, clarity on what Congress would like us to do about end users, for example. Another area which is proving difficult is the push-out provision for derivatives. And I think more generally, I think we all agree that the burden of regulation falls particularly heavily on small community banks, which don't have the resources to manage those regulations very effectively. So I would say as a general proposition that we ought to work together to try to find ways to lower that regulatory burden on those smaller institutions.
Well, thank you, Mr. Chairman, and I appreciate your advice and your expression of willingness to work with us on these and others as we move forward to try to improve our regulatory climate. Last issue, at least that I'll have time for in this round, is I want to talk about the crisis in Europe. Last week, the European Union released its 2013 forecast for the Eurozone economy, and the EU economists predict that the Eurozone economy will shrink for the second year in a row and the third in the last 5. What specific risks does a prolonged recession in Europe present to the outlook for the U.S. economy?
Well, the risks that we've been facing for the last couple of years have been primarily financial, given uncertainties about the stability of certain countries' sovereign debt, given the risk-on, risk-off behavior we've been seeing in financial markets as news comes in about financial developments. The European Central Bank has taken a number of important steps, including most recently the outright monetary transactions, which have helped to bring down the sovereign debt yields for the more fiscally challenged countries. That's been helpful. There have been a number of other positive steps which have generally reduced the financial stresses in Europe, notwithstanding the issues raised by the Italian election yesterday and today. And so while that remains a concern, I think the financial stresses are certainly less today than they were over the last 2 years. At the same time, as you mentioned, even as the financial stresses have moderated to some extent, the European economy and the Eurozone is in recession. Unemployment is rising, not falling. And that affects us in a number of ways, partly through financial sector, but also simply through trade. Our economy prospers when we can export, and the European market is an important market for us, and we've noticed a decline in our ability to export to Europe. So that's a risk as well.
Thank you.